And now, in studio, bringing his Midwest values from the Show Me State to the land of San Diego. He's a triple threat, licensed as an attorney, mortgage broker, and a top producing realtor who's crushing the competition. Here to deliver you what's happening in the trenches of the market. Your host, Michael Gaddis.
Welcome back to the Michael Gaddis Show on AM 1170 The Answer. I am your host, Michael Gaddis of FrontierLoanGroup.com. I am again joined by Will Afzali of FrontierLoanGroup.com. And how you feeling today, Will?
You know, I was freezing, but now I'm a lot warmer.
Yeah, he regrouped during the break, and he's ready to go.
I don't have Michelle next to me taking selfies.
That's right. Michelle's not here today taking selfies of herself, but she's here in spirit. So anyway, let's talk a little bit about reverse mortgages. One of the things I want to talk to you a little bit about is the fact that, you know, there's a lot of myths and misconceptions, and there's a lot of hurdles that people, have about reverse mortgages. Will, what's the number one hurdle, or the number one, concern that people seem to have when they talk to you?
You know, once they get past, once they get educated on the product, it comes down to what does it cost?
Right, the cost.
Yeah.
And that seems to be a really valid concern because, I'm going to go through costs here right now for all of you, and it might seem a little daunting, but I'm going to show you that there's a way that you can mitigate those costs. There's a way that we can decrease those costs. But I'm going to go through and talk to you a little bit about what the costs are first. Now, reverse mortgages, one of the things about reverse mortgages, they're an FHA product. So being that it's an FHA product, there's upfront
mortgage insurance.
Thank you, Will. An upfront, there, you see, he's got his game back. There's an upfront mortgage insurance premium that's due. And when you have the upfront mortgage insurance premium, that's where the price can get a little daunting. Now, that upfront mortgage insurance premium does not go to the broker. It does not go to Frontier Loan Group. It does not go to whatever broker you're using, or lender for that matter. Where it goes is it goes to the FHA. Mm-hmm. And that...
But more specifically, what does it do?
That insurance, that you pay costs money. So now... The upfront mortgage insurance premium costs typically 2.5% of the fair market value of the house. That's 2.5% of the fair market value of the house, up to a max of $625,500. So now someone might be out there going, "Man, that's a lot of money." Well, it is. It can be, but as I mentioned, there are ways that we can minimize that cost. But one way that we can minimize it is that we basically there's a rule that basically says if you're only using 60% or less of your eligible principal balance, the upfront mortgage insurance is not 2.5%. Get this, it's 0.5%. Half. That's a big difference. 2.5 versus 1/2.
That's a huge difference.
That's a huge difference. Now, you guys are probably out there listening right now going, "Well, what is an eligible principal balance?" Well, I'm going to tell you what an eligible principal balance is. An eligible principal balance is basically where they take the fair market value of your house and multiply it by a factor based upon your age. So if you are 80 years old, that factor is 65.7%. So if you take your home price times 65.7%, and that is your max eligible principal balance. That's how much the reverse mortgage will allow you to borrow up to. Now, so you have that number. Once you have that number, if you're going to utilize in the first year 60% or less of that, then your upfront mortgage insurance is only
0.5.
That's right, 0.5%. So since it's only 0.5%, your upfront closing costs are considerably less. Now the key is this: you have to, if let's say you have an existing mortgage that you're paying off, and then you have access, in addition to that, into, let's say, a line of credit. As long as your existing mortgage does not exceed the 60% threshold, this is an opportunity for you to try to minimize your upfront mortgage insurance premium. Now, how do you do that? Well, you do that by capping your line of credit during the first year to the 60% threshold. and I'm not trying to confuse anybody out there. I know it sounds like it, but what I'm trying to get at are there are methodologies and ways that you can minimize this. And I know what happens because I get a lot of people who are getting reverse mortgages. They will come to me and they will show me their HUDs or their good faith estimates from other people. And I can see, doing some mathematics if there are alternatives to try to reduce their closing costs. And that is one of the first things I look at that to see where are they at in regards to their eligible principal balance. If their ratio is above 60% with an existing mortgage, then we can't use this methodology. However, if it's not, as long as the borrower is willing to maybe potentially cap the line of credit during only the first year. So I'll give you an example. We had a client in Oceanside. This client basically was at about 50% of his eligible principal balance when he paid off his mortgage. So he had access to, it was lower than that. He had access to about a $160,000 line of credit after paying off his mortgage. $160,000. It was a lot. So when you look at it, you have a $160,000 line of credit, and then when we ran his numbers, his closing costs were coming up really high. And I was talking to Will, and I said, Will, we got to find a way this is crazy. This is too much money for this. There's got to be a way to fix this. So what we did is what did we do?
We capped it at 60%.
That's exactly what we did, and we reran the numbers. Now, what had happened to him? Well, at that point in time, he was only allowed to have an initial line of credit during the first year of I think it was $11,000 or $12,000. So of the 160. Now that was okay with them because when I presented the two options to them, because I always like to present people with multiple options. The first option I showed them was without capping it, which had the high closing cost. The second option was with the low closing cost with the cap.
Well, a lot of people also think that, like you said, if you use up to 60%, they're not going to have access to the other 40%.
Right, and that's not what happened. What happened is we capped it in the first year, and I asked him, I said, hey, look, is it really important for you? Because right now we're eliminating your mortgage payment, which I think their mortgage payment was like $800 a month. So right there, they were saving $800 a month that they didn't have to pay because obviously in a reverse mortgage, you don't have to make the payments. It gets deferred onto your principal. So they were deferring that $800 a month, and they were like, wow, that's a big swing in and of itself. And I said, and you're going to have access in your line of credit to 12, I think it was around 11 or 12,000. And I said, but on the 1 year anniversary, you're going to have access to 160,000. And they were like, it was a no-brainer decision for them because they saved, I think it ended up being like $10,000 or $11,000.
Yeah.
It was a huge difference by them just waiting 1 year to tap into their line of credit. So it's one of those things where you have to go to somebody who knows what they're doing, and you have to find ways to minimize those costs because it can be a little bit daunting. The other issue is origination fees. Reverse mortgages allow you to charge how much in origination fees?
$6,000.
Yeah, the rule caps it at $6,000. Now, Frontier Loan Group, we don't typically charge that origination fee unless your loan balance is really low. So if your loan balance is below, $100,000, then we might have to, maybe investigate an origination fee. But if you start exceeding that $100,000 mark, there's no need for us to charge an origination fee. So we can eliminate that upfront cost right there. So if we've capped your eligibility at 60%, and we've reduced the fact because you don't have to pay an origination fee, as long as your initial principal balance is above $100,000, then you've eliminated the $6,000 origination fee plus the upfront. You've reduced the upfront considerably. So that's two things right there. So there's a lot of different ways and methodologies that you can look at these reverse mortgages to try to reduce the upfront cost, because ultimately you have to pay for title, you have to pay for escrow, the traditional cost of a refinance, and you have to pay for the for the upfront mortgage insurance premium, whether it's the full 2.5 or the 0.5. So, but the key is finding somebody that is good enough and understands the program well enough that they can put those options in front of you. Wouldn't you say, Will?
That's exactly it. You hit it 100% correct.
Well, I want to thank Will Afzali from Frontier Loan Group for coming in today, and I know you froze up a couple times, buddy, but you are nails. And for everyone out there, Will is really analytical. No, he's he's really a research guy. Will, I'll ask him a question. He'll come back like in 5 minutes, and he'll have every answer under the book. He researches everything, so he's a wealth of knowledge. He froze up a little bit today, but I'm telling you, the man knows his stuff. So I want to thank him for taking time out of his day to come and talk to us today.
Thank you for having me here.
Well, I wanted to go into a little bit of the difference between using a broker and a direct lender, but we're out of time because Paul's over there waving at me again. Once again, Paul, Party Pooper Paul. That's your new nickname, Party Pooper Paul. All right, well, thank you all for listening, and you know what? I'll be back here again next Wednesday at 8 p.m. I'm sure Party Pooper Paul will be with us. And who knows, maybe even Will take some time out of his day to come back and visit us as well.
I would love to.
So you're listening to the Michael Gaddis Show on AM 1170, The Answer.